Hello, this is study time. Preparation for general lines, life and accident and health insurance license. Let's talk about really quickly cliffs, short cliffs notes about life insurance premiums, proceeds, and beneficiaries. So let's talk about primary factors in premium calculations. Three: mortality, interest, expense. Mortality measure the number of deaths in a given population, gives the idea how much you predict, how much you're going to pay in that group. Interest, every amount of premiums they have an amount that will be to earn interest, and the rate of earnings will be to reduce the premium rates. And expensing factors, insurance companies are just like any other business. They have operating expenses that will be also factored in the premiums. Their expensing factor is also known as loading charge. Benefits. The number of kinds of benefits provided by a policy affects premium rates. The greater the benefits, higher the premium. To state any other way, the greater the risk to the company, the higher the premium. Like there are other factors that impact premiums: age, sex, health, occupation, hobbies, habits, everything that can just create risks to the company. Mode refers to the premium payment schedule and permits the policy owner to select a timing of premium payments. Insurance policy rates are based on the assumption that the premium will be paid annually at the beginning of policy year, and the company will have the premium to invest, the interest factor, for a full year. If the policy chooses to pay premium more than once a year, there will normally be an additional charge because the company will have additional charges for billing and premium payments. So let's work on this idea. The highest the premium payments, higher the premiums. Level premium funding, the policy owner pays more in the early years for protection to help cover the cost in the later years, which allows the premiums to remain level. So the shorter the premium paying periods, the higher the premiums, and vice versa. So policy owner pays more in the early years than in the end of the years to help cover the costs in the later years. It's like housing. If you pay more insurance in the beginning and then you pay less insurance in the end. Single premium funding. The policy owner pays a single premium that provides protection for life as a paid-up policy, normally associated with life insurance. So with single premium, the policy owner pays a single premium that provides protection for life as a paid-up policy. Reserves versus cash value. Reserves, money that together with future premiums, interest, survivorship benefits will fulfill an insurance company's obligation to pay for future claims. Cash value applies to savings elements to the whole life insurance policies that are payable before death. However, during the early years of whole life insurance policy, the savings portions bring very little return compared to the premiums paid. So let's continue. Comparing life insurance policy costs. Life insurance cost comparison methods are used to evaluate the cost of one life insurance policy in relation to another so that consumers can be better informed when shopping for the most competitive price offering for their particular needs. So comparing life insurance is important because they can provide the same, because the loading costs, they can cost more. Surrender cost index. Use a complicated calculation formula where the net cost is averaged over the number of years the policy was in force to arrive as the average cost per thousand for a policy that is surrendered for its cash value at the end of the period. Surrender cost index. net payment cost index. Use the same formula as surrender cost index, with the exception that it doesn't assume the policy will be surrendered. This is more like to understand how much people are paying, just to understand how much people are the cost of index that are being paid at this point. Tax premium, tax treatment of premiums. Premiums paid on individual life insurance policies are generally not deductible. So let's repeat. Premiums paid on individual life insurance policies are generally not deductible. Premiums for life insurance for business purpose are generally not tax deductible. So think about that. So premiums are not deductible. There are just some exceptions. Premiums that are used for charity, life insurance premiums paid by an ex-spouse as court order alimonies are tax deductible, and employee paid premiums used to fund group life insurance for a benefit of employees are tax deductible. So there are not a lot of tax deductible on this, only specific exceptions for charity, for alimony, and employee paid premiums to fund group life insurance are tax deductible. This is important. I think this is what we're going to go in the test. Tax treatment of cash values. If cash value is surrendered, a portion that exceeds the premium is taxable. For policies that are not surrendered, the cash value goes tax-free. As long as the cash value stays in policy taxes will never be imposed on any portion. So cash value is if cash value is surrendered, portion that exceeds the premiums paid is taxable. For policies that are not surrendered, the cash value goes tax-free. That's interesting. Let's continue. Policy proceeds. Death benefits. Death benefits can be paid in several different ways. Can be paid in lump sum. It pays in a single payment. There is an interest only. Insurance company holds the death benefit for a period of time and pays only the interest earned. A minimum rate of interest is guaranteed. The interest must be paid annually. A fixed period, what we call per period certain. The fixed period option is when the insurer pays proceeds in minimum guaranteed dollar payment of over a specified number of years. Part of the installments paid to the beneficiary consists of interest calculated on proceeds of the policy. The dollar amount of each installment depends upon the total number of installments. Fixed amount installments option pays the fixed death benefits in specified installment amounts. Life income option provides the beneficiary an income that cannot outlive. Installment payments are guaranteed as long as the recipient lives. The amount of each statement is based on the recipient life expectancy. It gives the potential greater return or potential greater loss based how long the insurers live. Joint and survivor benefits will be paid on a loan basis to two or more people. This option may include a period certain, and amount payable is paid on the ages of beneficiaries. Living benefits. The living benefit is the option to use some of the future death benefit proceeds when they may be most needed before their death. This is the accidental death benefit. So that's also called living benefits. Living benefit options. Accelerated benefits. Just if you have a terminal ill, you get accelerated benefits. Via co-settlement, you can sell your insurance and get percentage of it. So you have two ways. You have accelerated benefit or viatical settlement. So the one you can just take the money, amount benefit is received tax free. Is the allow someone with a terminal illness to sell the insurance and get a percentage of the death benefit. Tax treatment of proceeds, premiums, not tax deductible. Death benefit, tax free if taken as a lump sum. Death benefit installments, tax free. Interest is taxable. So let's repeat. Premiums, not tax deductible. Death benefit, tax free if taken in lump sum. Death benefit installments, principal tax free, interest taxable. Taxation proceeds paid at death. Life insurance proceeds to paid to a benefit are insured tax-free if taken in a lump sum. So let's go back. Death benefit, tax-free if taken in a lump sum. Proceeds passed directly to a beneficiary and are not subject to attachment by the insured creditors. So let's continue. Taxation of proceeds paid uninsured lifetime. Policy surrender. If a policy surrender for the cash value, some of the cash value received may be taxable if the value was more than the amount of the premiums paid by the policy for the policy. Accelerated death benefit, when benefits are paid under a life insurance policy to a terminally ill person, benefits tax-free. To be considered terminally ill, physician must certify that the person has a condition or illness will result in a death in 2 years. Accelerated life benefit tax-free. So you don't have too many options here. Premiums, not tax deductible. Death benefit tax-free. Accident accelerated death benefit is tax-free, and death benefit installments principal is tax-free, interest is taxable. Let's continue. 1015 exchange. When an existing life insurance policy is assigned to another insurer for a new contract, the transaction may be treated for tax purpose as a Section 1036 exchange. Policy exchange that qualify as 1036 exchange are not taxable. When an existing life insurance policy is assigned to another insurer for a new contract, the transaction may be treated for tax purpose as a 1035 exchange. Policy exchange that qualify as 35 exchange are not taxable. Beneficiaries qualifications. There are a few restrictions. Will be named beneficiary, so that we can have that. Types of beneficiaries, we have primary, secondary, tertiary. Distribution by descent per stirps, meaning by bloodline, and per capita, meaning by head. So if it's by bloodline, in the event of beneficiary dies before the insured benefits will be paid to the beneficiary heirs, which is stirps, I think it's stirps, by bloodline and by head. Evenly distributes benefits among all living beneficiaries. This beneficiary is revocable, irrevocable. I think I know I got it. That simultaneous death under a Uniform Simultaneous Death Act will assume that if the primary die first, this allows the death benefits to be paid to the contingent beneficiaries. Common disaster provision. With a common disaster provision, a policy owner can be sure that if both insured and the primary beneficiary die at a short period of time, the death benefit will be paid to the contingent beneficiary. Spendthrift clause prevents a beneficiary from recklessly spending benefits by requiring benefits to be paid in fixed amounts or installments. So just to not receive $1 million and then you spend everything. And facility of payment allows the insurance company to pay all or parts of the proceeds to someone not named in the policy that has a valid right. This is usually done on behalf of a minor or when the named beneficiary is deceased. Facility of payment allows insurance to be paid to someone else. All right, I think we're done. Thank you, and keep up studying. Have you enjoyed our content? Insurance Nation is a website that a location that I created in order to find some content, in order to help you to pass the insurance general lines insurance test. If you have enjoyed our content, please join us on YouTube. We'll always be able to just add more content down there. We'll be able to just provide some real examples, go to websites, and at the same time, we want to hear from you. If you want to have any questions or something that you have some questions about the test or something that you'd like for me to place it on this website, please let me know. I will be glad to help you out. Go to Insurance Nation at ideanaso.com and feel free to provide any kind of donation of any size. Thank you, and see you next time.